Let's take us to our talk of the tape. Where to find the best opportunities within this bull market right now? And let's ask our panel that very question. Adam Parker is the founder and CEO of Trivariate Research and a CNBC contributor. Lauren Goodwin of New York Life Investments. Kristina Hooper of Invesco. Welcome, everybody. It's good to have everybody here. You're still defensively positioned. So you said probably sell the first rate cut. Well, we got the first cut, but why are you defensively positioned? We've been hitting new highs here.
So the note that we wrote this weekend was there's nothing worse than being a consensus bear and being wrong. It's like the worst thing you can do is everyone's cautious coming in September, and instead of it being the self-fulfilling prophecy, it's like wrong. And, you know, there's some new news. Obviously, this China stimulus is a positive. Generally, when they do stuff, it helps, you know, energy materials and industrial. So that's incremental from, you know, maybe a few days ago. But I'm trying to take a step back and say, what do I believe is like a reasonable scenario for the economy and for corporate earnings? Can I stretch it to get, you know, sort of $300 in 2026 earnings for the S&P? Should I pay 20 times that? That gets me about 6,000. So, okay, I can see, like, you know, I'm paying 20 times 2026 earnings right now in a slowing economy while they begin to stimulate. Maybe. It's just really hard for me to walk in and say, I think there's like 10, 15% upside justifiably. So I feel like I can pick stocks in this environment more than I feel like I want to just, you know, chase, you know, what's been a massive rally.
Do you think statistically earnings tend to do better in a lower rate environment? Do stock prices tend to do better in a lower rate environment?
Yeah.
Is the answer yes?
It's more the latter where, you know.
I'm asking you that because you have a PhD in statistics. Yeah. I'm playing around with you a little bit, but you know what I mean.
Yeah, what I wrote in the note is I think there's a 90% chance earnings come lower and a 10% chance they come up, and a 50% chance the market goes up and a 50% chance it goes down. You know, like, I know the earnings estimates are too high for Q4, and, you know, I thought FedEx and maybe, you know, we'll see. There's some bellwethers that are starting to show a little bit of squishiness, but on the other hand, you know, I'm less confident that we just won't have more multiple expansion because there are some things that I can dream about that can cause margin expansion, particularly around productivity, you know, AI deployment, et cetera. So
aren't we seeing that?
We are, and I think you'll see more of it. And I think what's in the price now is a pretty healthy rebound in the 2025 earnings and continued growth into 2026. And I'm paying a, you know, pretty chunky multiple on that 2026. I think it's possible. I'm not like saying, hey, short stuff, but I think, as we've been saying, like, I just don't know if I can believe 10% upside is more likely than 10% downside until I get a little bit more confident on how much the consumer's slowing. There's no question the consumer's slowing.
Let's just take it, Lauren, base level, right? Let's go back to the beginning of when the Fed does what it's doing, right? 09, we learned from 09, don't fight the Fed, right? Somebody came up with that at some point, and it's worked on both sides. They start hiking, stocks fell sharply. They start cutting, aren't stocks supposed to continue to rise? And isn't this a boost to stocks? That's what they say. Are they right?
I think in this circumstance, they're right for now. But the reality is that it's still all about growth where stocks go next. And it's actually true for profit margins as well. When the Fed is cutting historically, profit margins stay about where they are, earnings stay about where they are until growth slows. And so that's an environment where the equity market can continue trudging higher. But it's difficult to see the real economic catalysts that get us a real upstart in growth without inflation that the market would be happy about. And so I'm a buyer of this rally until unemployment claims start rising, until earnings start declining, really until growth's a problem. But I think we're going to see a really volatile market between those growth and slowdown narratives until that time.
We are trying to, Kristina, make investment decisions in some respects based on historical precedent. You've heard, you know, some of the commentary here and elsewhere. Well, you know, when the Fed starts cutting interest rates, it typically does this, or back in 1990, whatever, this is what happened when the Fed was cutting interest rates. And I know you step into a big pile of, you know what, when you try and suggest that this is different this time. But this is unprecedented. Has the Fed ever started cutting interest rates at a time when the economy was as reasonably good as it appears to be today?
It is hard to find a place in modern times where this has happened.
By 50 basis points, nonetheless?
A crisis cut in a non-crisis environment. Absolutely. It's unheard of. And I think we have to recognize that the Fed is cutting into growth. Now, yes, we are going to see a slowdown, but I think it's going to be very, very brief, and that we're going to see a reacceleration. Not only do we have 50 basis points already, but we're looking out on 50 more this year and significantly more next year. In fact, if we listen to some of the FOMC members, we can expect more and more cuts. This is an environment, I think, where we're throwing a lot of jet fuel behind stocks. Now, it doesn't mean that we're going to see the stock market go crazy. But I do think, especially those areas that haven't had as big a rally, especially the cyclicals, where there is an expectation that if the economy does reaccelerate, they'll perform well. We'll see that. And what's happened today in terms of the China announcement is only helping that.
I want to go back to